Now, without further ado, we'll turn it over to Stephen Sweeney.
Thanks so much, Megan. Really appreciate that introduction. It's a real privilege to be able to be here with everyone today, and greatly appreciate the chance to be able to share some of these ideas around what is perhaps one of the most important discussions as folks are in retirement or getting closer to retirement. And that, of course, is Social Security. Now, if you've done any research on your own, or if you're familiar with Social Security at all, you know that there is a lot of information out there. There's a lot to take in addition to this being a very important decision, it's a very complex one. And our goal here today, above anything else, is to really do our best to distill that down, that information as best we can, so that as folks are doing their own due diligence, they can position themselves to make the decisions, I should say, that make the most sense for them individually. Now, one of the other things about Social Security that you'll find is that there is no one right answer that applies to everybody. It was as simple as, Googling when should I turn on my Social Security benefit, we probably wouldn't have, set seminars like this. It is really unique to the circumstances of each individual in terms of when you should turn it on, how your benefit is calculated, and all these different things that we're going to unpack here today. But the good news is even though it's a very daunting topic, is that if we can wrap our arms around a handful of key points, do our due diligence and develop an understanding of those key areas, we can really make a decision that's informed and that makes the most sense for us. And that's really sort of the context within which we are having this conversation today. So welcome again. Hold on to your hats. We've got a lot of ground to cover in a relatively short amount of time. And hopefully we'll give everybody all the tools that you need to take that best step forward in terms of understanding how Social Security can be optimized for you and to be in a position where you're making informed decisions. So a couple of things that I think we sort of have to clear the air with as we're getting started. And the first is that, it's actually not on the slide here, but I always like to point out where I'm coming from in terms of my perspective. So I don't work for Social Security in any way. I just happen to be somebody who's been in the financial planning business for almost 20 years now and has taken on roles in the areas of addressing more complex issues related to things like retirement income and portfolio distribution strategies. And one of the things that you find in that part of my business is that Social Security is connected to so many different aspects of the decisions that investors are making today. So I've, over the years, have become somewhat of an expert in these areas as a result. But I'd like to just sort of clear that point, because I'm a representative of an organization that Allianz Life Insurance, that you may see in the news. You may see us on the marquee at certain stadiums. We've actually got a stadium in Australia where the Women's World Cup is being played right now. There'll be some games played in that stadium here over the coming weeks. So I work for an insurance company, not Social Security, and my background is in financial planning. So it's really about trying to figure out how the benefit can be optimized for each individual. That's where we're coming from here today. And again, this is not a cut and dry conversation. Your Social Security benefit is different than that of your neighbor or your brother or sister, your parents' Social Security. It's unique to your own situation. And in addition to that, you've also got perhaps a lot more control over that decision-making process than you may realize. And so a lot of folks sort of think the decision is already made and it's cut and dry and there's not much to it other than turning it on. And that's simply not the case. You can make a big difference in the outcome that you actually experience and hopefully get the program to work for you. Manage it on your own so that it can work for you in your individual circumstances. All right, so what are these 7 key areas that we see as the most important as it relates to this Social Security filing decision? Well, we have them listed here, and then this is also going to be used as our agenda. This is the framework for this conversation that we're having. This is no accident, too, that this is the most common area of questions that we see. We, as an organization, field somewhere around 10 to 12,000 questions a year from our consumers around Social Security. And those folks that answer those questions are on my team in our home office back in Minneapolis. And these are the most common areas where people have a concern or are wondering more about their own benefit. And that's exactly how we'll approach this, is by unpacking each of these areas. And the first is benefit basics. So when we talk about benefit basics, really what we're referring to is having an understanding of the broader contours of Social Security and really the role that it plays in our society and in the economy at large. And so here we're speaking to the fact that Social Security as a benefit for the for a large portion of the United States and an increasingly large portion of the United States population, the size and scale of it cannot be overstated. So last year alone, there were over 65.6 million beneficiaries and over $1.2 trillion in benefits were paid in that 1 year. When you combine retirement benefits and survivor benefits and spousal benefits and disability and SSI as well, over $1.2 trillion. You know, it's a big number when you're rounding up or down based on around $100 billion, right? So that 0.2 represents a sizable margin there when you're considering what rounding one way or the other. So again, you cannot overstate how huge of a benefit this is. And if you were to break down what type of benefits being paid out of that 1.2 trillion, about 77% is going to retired workers and their dependents, so their children potentially as a survivor, depending on what age they are, and or their spouse as a survivor benefit. 14% of which goes to disabled workers, and then 9% goes directly to the survivors of deceased workers as well. So, the takeaway here, folks, is that, the vast majority of that 1.2 trillion is going to retirement benefits. And that's what we're going to focus on for this discussion. And of course, that retirement benefit is what you become eligible for based on your work history. More on that to come later, but it's that benefit that you become eligible for after you've worked a certain number of years in the workforce. Now, another thing that's important to keep in mind in terms of context is that on average, the retirement benefit is a little under $1,700 per month. So that's sort of, the average amount that somebody would receive when considering the entire population in the United States. The maximum amount of benefit that can be received is actually significantly higher than that. It's a little more than twice that figure, but people receive a lower benefit based on one of two factors. Either they file early, and by early, we mean prior to their full retirement age. More on that to come in a bit as well. So they either file early or they didn't earn enough to be eligible for that maximum during their working years. And we'll talk a little bit more about how that's all calculated too. But again, just understand that most people don't get the maximum amount of benefit that they're eligible for based on one of those two factors. And you'll start to see as we go through here how the decisions that you're making along the way can really make a big difference then in the outcome, sort of what end of the spectrum you ultimately end up on. So another important question about Social Security is, will it be there for me? There's been a lot of headlines out there over the last, say, 5 to 10 years or so about the financial solvency of Social Security. And while, yes, we'd probably all agree that it is under some degree of financial stress as a result of the aging population, the changing demographics that we're seeing here in the United States. Basically, there are more beneficiaries from Social Security when compared to the workers who are funding it. That ratio has been weighted more towards the beneficiaries, more so than it ever has been before. But it's important to understand exactly where it stands right now. So the trust fund, where all the assets are held when our tax dollars are paid, right? Our FICA taxes that fund our old age and survivor disability insurance, Social Security program goes into this trust fund, and it holds trillions of dollars in there. And it is basically based on actuarial tables and how much benefit is due to those beneficiaries. Payouts are made from that fund. So there's money coming in, there's money in reserve, and of course, then there's money going out as well. Well, the money that's in reserve is projected to be depleted in the year 2034. Okay, but when we see that money, and we want to make clear on that with that. That what that's saying is that that's the money that's in excess of what's coming in, right? So even at that point where the trust fund has been depleted, the money coming in from taxpayers and they're still in their working years would still make up for or would be enough revenue to pay about 77% of scheduled benefits. But it's important to understand that that's assuming nothing changes with the program between now and then. And there almost certainly will be some changes in the future. What those changes are, we don't know, but most would probably agree that they're not going to scale back benefits that have already been promised to people. And there is some time to figure this thing out. But it does take some political actions, or I should say legislative action in Washington to get that done, to get it on sure footing. And we can certainly hope that by the year 2034 that is the case. Now, another really important thing about Social Security, understanding how it works for you specifically, is to make sure that you're getting your statements each and every year at least, and you're reviewing those statements. And that begins with establishing your account at ssa.gov. And establishing your account will allow you to see what your projected benefit is, how your wages have been reported to Social Security from the IRS, and you'll get this statement. And those of us who've been around long enough remember when these statements were mailed to us every couple of years. That's no longer the case. You no longer get those mailed automatically. You do have to go in and establish this account online and get those statements, which are available then in PDF that you can certainly print out. But it's a great idea when you're working with your financial advisor who invited you here today to make sure you print that out and bring it to at least one of your review meetings a year so that you can see exactly how much income is being provided by the program. You don't have to sort of guess what it might be. Oh, it's around $2,000 per month. That's not good enough. There's too much at stake here with this, and there's too many different ways that you can make the benefit work for you to make it a guessing game. Get that statement printed out, take a look at what you're eligible for as you're making those decisions, and hopefully you can be in that best position possible. Okay, so now let's shift our focus then to how our benefits are calculated and how we become eligible for some form of benefit. So the first question we want to address here is becoming eligible in the first place. Now, one becomes eligible for Social Security based on their earning of credits in the workforce. And you have to have earned 40 credits to be eligible for some form of benefit. Now, you can earn a maximum of 4 credits in a given year. So that 40 credits equates to, of course, approximately 10 years in the workforce, assuming that there were no breaks in the meantime. But those credits don't have to be earned consecutively. So for example, somebody could have gone into the workforce for 5 years, earned 20 credits, and then taken 10 years off and come back to the workforce for another 5 years. And they would have been eligible then for their own retirement benefit because they would have earned those 40 credits. Now, 1 credit equals about $1,640 in wages. So basically, whenever somebody earns about $6,500 in wages, they have earned their 4 credits in that given year. Now, importantly, though, what we're talking about up until this point is how somebody becomes eligible for some form of benefit. How much benefit somebody receives is based on their earnings history. Okay, so basically what Social Security does is they add up your highest 35 years of wage history. They look back at all of your tax returns. Essentially, they report them from your tax returns each year to Social Security, and they add all that up, and they look at what your highest 35 are. They index them for inflation using this average indexed monthly earnings calculation. And it's that determines what your baseline benefit is at full retirement age. Your baseline benefit is considered your primary insurance amount. And that's, again, what you're eligible for when you reach your full retirement age. Your full retirement age is going to be based on the year in which you were born. For most of us here, it's going to be between 66 and 67. If you're born after 1954, you will have a 2 months added to your to age 66 for every year after 1954 that you were born. And if this sounds complicated, it is. You're not alone if this feels complicated to you. But the good news with this stuff is that, this is all in that statement that we were referencing earlier. All of your information about what your full retirement age is, what your primary insurance amount is all going to be in that statement. And what we want to tease out from this conversation more than anything else is that if you were to start your benefit prior to full retirement age, because there is an option to do that as early as age 62, if you start it prior to that, it's going to be reduced. It's going to be reduced based on the number of months prior to your full retirement age that you decide to turn it on. Now, it also can be increased by as much as 8% each year for every year that you wait past your full retirement age to turn it on. So if, for instance, my benefit is $1,000 per month and my full retirement age is 67, and I decide to wait until 68 to turn mine on, well, that $1,000 per month would actually increase then to $1,080 per month for the rest of my life. So here you can see, there isn't one right age for everybody. It really depends on what your circumstances are, what the rest of your portfolio looks like, where those assets can be drawn from. And then ultimately, I think that we want to offer up is this is a great opportunity to work with your financial advisor, to look at the makeup of your portfolio, make sure that you're sharing with them all of the different resources assets that you have available so that you can make that informed decision around this. Because while you do have flexibility in turning on your benefit and, the waiting versus early and what have you, once you do turn it on, it is somewhat of a permanent decision. So let's talk a little bit more specifically about what we mean when we say, when should somebody turn their benefit on and what that reduction might look like. So there are really three thresholds in terms of ages that we want to be aware of here. The first is age 62. So 62 is the earliest point at which we're able to turn on our own retirement benefit, also our spousal benefit, by the way. We'll talk more about that here too in a bit. But that's the first point at which we can turn on our benefit. But if we turn it on as early as possible, there is going to be a reduction. And the point at which that reduction no longer applies is what we referenced earlier, full retirement age. That full retirement age is when we're eligible for our primary insurance amount. And that's a benefit that is reduced. And if we were to wait past our full retirement age, we would get 8% for every year that we wait up until age 70. So for somebody who has a full retirement age of 66, that could mean if they wait until 70, that their benefit could increase as much as 24%. So you can see this wide range of options. And in particular, where somebody has a longevity on their side, they may live longer. Oftentimes, folks run the math, they work with their financial advisor, and they come to the conclusion that maybe getting as much benefit as they can because they're going to live longer would line up with the strategy that calls for them to wait. Now, that's not always the case, but oftentimes that is the result. So another thing that's important to bear in mind here is that what the reduction looks like if you were to file early. And that's what we're sharing on this chart here. So if somebody's full retirement age was, for example, 67, they were born in 1960 or later, their full retirement age is 67, but they decide they're going to turn their benefit on as early as they possibly can. Again, that would be age 62, well, that would coincide with a 30% reduction in their benefit for the rest of their life. So, you can run the math there, and that's a decision that for all intents and purposes really cannot be undone. Now, another important thing to consider here when we're thinking about those ages at which we're turning on our benefit is whether or not we're working. So the first thing that we want to consider here is what's known as the withholding provision. So where somebody is filing for their benefit prior to full retirement age, okay, and they are still earning wages, the Social Security Administration will actually withhold $1 in benefit for every $2 in wages that somebody earns above that threshold of $21,240. So anybody earning substantial income and decide to turn on their benefit prior to full retirement should take this into consideration, because their benefit could be reduced from month to month pretty significantly. Now, the year in which somebody turns full retirement age, that calculation for the withholding is reduced in the favor of the Social Security beneficiary, but it's still a withholding provision that applies. $1 is reduced from their benefit for every 3 above the threshold of $56,520. Now, another important consideration here, though, is that once somebody reaches their full retirement age, this withholding provision no longer applies. So once you reach that point at which you have your primary insurance amount available to you, you could make $1 million a year in wages and see no reduction in your benefit. So for those who do have substantial wages in their later years of their career, for the most part, it makes sense for them to wait to turn it on until at least their full retirement age, so that doesn't apply. So let's take a quick moment here to unpack this, and using a hypothetical example. We'll assume that we have Tamara here. She's born in 1960. She's eligible for the average amount of benefit of $1,669, and she has decided to turn her benefit on early. Okay, we'll assume that she is earning about $40,000 in that given year. Annualized, her $1,669 in benefit is $20,028. And she's going to see a reduction because she's 62, she's filed early. She'll see a reduction to $14,020 for that given year. Okay, now this, because her earnings are above that threshold of $21,240, that withholding provision is going to apply. In this case, she has $18,760 in earnings in excess of that threshold, which means that her benefit will be reduced by $9,380 per year, netting her benefit to just over $4,600. So her benefit goes from $14,000, a little over $14,000, to a little over $4,600 because she has filed early and because she is still earning wages. And notice that that wage threshold is pretty low here. So it doesn't take very much income to have an impact on what you receive from month to month. And this is a great example of something that you would want to talk to your financial advisor about to see what type of options you may have in terms of distribution strategies. But generally speaking, for those who are working between age 62 and their full retirement age, if they can wait to file their benefit, it's going to be in their favor to do so. Now, another part of this discussion around Social Security is how it's considered taxable income, or when and where it's considered taxable income. So for the purposes of determining what portion of your benefit is taxable income, the Social Security Administration uses a unique calculation that's referred to as your combined income. And essentially what it is your adjusted gross income plus non-taxable interest, and then half of your Social Security benefit. And when you add those figures up, if you're a single taxpayer, if that sum of those figures exceeds $25,000, well, then up to 50% of your benefit can be considered taxable. And for that same single taxpayer, if your combined income, the sum of those three figures, is in excess of $34,000 per year, well, then up to 85% of your benefit is considered taxable income. Married filing jointly, it's a little bit more favorable. $32,000 or up to $32,000 is the point at which your benefit is not taxed. But then once you do surpass that $32,000 threshold, up to 50% of your benefit is taxed. And then after you exceed $44,000 as a married couple filing jointly for those combined income purposes, then 85% of your benefit is considered taxable income. All right, so a couple of notes here on spousal and survivor benefits. You know, when you're working with or when you have a married couple who have work history where they each are eligible for some form of benefit, there's a real opportunity to perhaps be a little bit more strategic. But even on the very fundamental level, where perhaps you might have one spouse who was the primary worker and the other spouse never worked a day outside of the house, even in that case, that spouse who didn't earn any credits for Social Security purposes would still be eligible for up to 50% of the primary insurance amount of the worker, even again without having earned any credit. So if, for example, My benefit was $1,000 per month. I was the primary breadwinner in our household, and my wife never worked a day outside of the house. Well, in this case, if she's full retirement age and I've turned my benefit on, she is eligible for $500 and I'm eligible for $1,000. As a household, we get $1,500 per month. So the only sort of criteria here in terms of the marriage qualifying is that the marriage has to have lasted at least 1 year, or that the spouse is the parent of their shared child. Now, in the instance where both spouses have earnings history and both spouses have benefit that they're eligible for, there might be a chance to turn one benefit on and then let the other one grow, and consider the different approaches that are taken. Here's another great opportunity to work with your financial advisor who invited you here today to figure out what options you may have and work through your retirement income plan, because very often you can maximize your benefit, maybe allow for those delayed retirement credits at 8% to be added for years that you're waiting while one spouse has turned theirs on. Just bear in mind that when you have a spousal benefit being paid, you essentially don't get to cherry pick for a spousal benefit. You can't say, oh, I just want my spousal benefit, I'm going to let mine grow. The Social Security Administration is going to give you the higher of the two. But where you do have two workers that are eligible for some form of benefit as spouses, one could turn theirs on and the other one could delay theirs for later. There just wouldn't be a spousal benefit in the meantime. Those strategies have gone by the wayside since about 2016, but there's still a great opportunity to be able to receive a little more benefit and to be a little more strategic when you have two spouses working together to figure it out. Okay, so also be aware of the fact that survivor benefits are paid to surviving spouses and certain dependents, provided that survivor is 60 years or older and is not remarried. So essentially here, what this is saying is that if you have a married couple, let's use my example again. My wife is getting her spousal benefit of $500 per month. I'm getting my $1,000. And we'll assume that I predecease her. If I predecease her, I pass away, she doesn't continue to get two checks. She doesn't continue to get $1,500. In that case, she would get $1,000, which would be the survivor benefit, or essentially the higher of the two. You also don't get your own benefit and survivor benefit. You would just get the higher of the two there as well. However, you do have an opportunity to turn your survivor benefit on a little bit earlier, as early as age 60. And in this case, you do have the chance to switch over to your own benefit later if that is ultimately in your favor, if you do have the work history to support that. There is an opportunity to switch from one to the other at some point in the future. Here again, working with your financial advisor is just so critical. Another thing to consider here related to spousal and survivor benefits is that, yes, even former spouses, ex-spouses, can collect based on their former spouse's work history, provided that the marriage lasted at least 10 years and that they are unmarried and that they're at least 62 years old. So the divorce has to have been at least 2 years ago. And those benefits, you can get a spousal benefit and even a survivor benefit based on your former spouse's work history if those numbers are higher than your own. So this is a great opportunity. If there are former marriages, to be a little more strategic here as well. But just bear in mind that the marriage has to have lasted at least 10 years, and that the spouse on which the benefit is being based has to have reached age 62. All right, so one last key point here that we want to make is we're moving through this material pretty quickly here. We're getting closer to the end already of the seventh key that we see for Social Security benefit is Medicare, sort of understanding the connection between Social Security and Medicare. And while, yes, they are two separate programs, they really are inextricably linked in a number of different ways. They're funded very similarly through payroll taxes and the FICA tax program in general. Two separate calculations and different thresholds apply, but very similar manner in which the programs are funded. But another really key connection between Medicare and Social Security is that if somebody is receiving their Social Security benefit at age 65, they will be automatically enrolled in Original Medicare Part B. B and Part A. So that means that, if somebody's benefit is, say, $1,500 per month, and they're receiving that, and early, obviously, because they wouldn't have reached their full retirement age. Let's say they're 65, they would automatically be enrolled in Part B, and the premiums for Part B would be reduced or subtracted from that $1,500 per month, and their check would go down, and they're now enrolled in Original Medicare automatically. You do have the option to opt out of this if you have coverage elsewhere. But you just want to be aware of the fact that if you're approaching 65 and receiving your Social Security benefits, to be aware that this may pop up because the two programs are connected on this level. And essentially what they're doing is encouraging people to enroll in Medicare and to avoid any gaps in coverage as much as they can. Also, if you are not turning on your benefit, or have not turned on your benefit, I should say, and you are 65, of course, they're not going to automatically enroll you. And the assumption there is that you have secured your healthcare coverage through an employer or through the private marketplace or somewhere else, but it's around age 65 that you want to start to, or as you're approaching 65, I should say, that you want to make sure that you're making that Medicare decision as well and getting enrolled properly. Because if you were to delay it past age 65, there could be penalties that incur with that part of that program as well. All right, so as I begin to wrap things up, let me just sort of close with a couple of statements, a bit of a review from what we've talked about. Again, understand that filing options are available to help you enhance your benefit, as we've discussed. It's essential to then have this discussion with your financial advisor to make sure that you're covering at least your basic expenses with this guaranteed source of income, and work with your financial advisor to see if there are other solutions that might be able to help fill any gaps that there might be, in particular for those stable spending requirements that you may have. In addition to just your essential expenses, make sure that your needs are met using your stable sources of income like Social Security. Others that might be out there are annuities and other types of programs that are available. We're not here to talk about that today, but just be aware of the fact that if you come to the conclusion that your Social Security is leaving you a little bit short in terms of what your guaranteed sources of income might be, there are solutions that are out there. And so with that, I'm going to go ahead and end where I started. And that's with, again, thank you. Thank you for the chance to be here with you. I genuinely appreciate it. We're going to take a couple of minutes to go through the questions if there are any that we haven't covered. But thank you again for the time. And with that, Meg, my friend, back to you.